There's a moment before every market crash that almost nobody sees coming. Not a dramatic plunge, not a panic sell-off, not headlines screaming catastrophe. Just silence. A blackout. The smart money simply disappears. And right now, in 2025, we're watching it happen again. Warren Buffett, the Oracle of Omaha himself, is sitting on $348 billion in cash. Let that number sink in. $348 billion. That's more cash than Apple, Amazon, Alphabet, and Microsoft have combined. It's enough money to buy every single NFL team, every single NBA team, and still have $34 billion left over. Berkshire Hathaway now holds more cash than it owns in public equity. More cash than the company has ever held in its nearly 60-year history. And Buffett didn't build this war chest by accident. He's been a net seller of stocks for 10 consecutive quarters. That's 2.5 years of selling more than buying quarter after quarter after quarter. But Buffett isn't alone. Michael Burry, the investor who famously predicted and profited from the 2008 housing collapse, just placed one of the most aggressive bets of his career. In the third quarter of 2025, Burry's fund, Scion Asset Management, disclosed a portfolio that had exploded from $578 million to $1.38 billion. And 79.5% of that entire portfolio is concentrated in put options, betting against two of the hottest stocks in the market. $912 million in put options against Palantir. $186 million against NVIDIA. That's not hedging, that's not caution, that's conviction. Burry is betting that the artificial intelligence boom, the rally that has driven markets to record highs, is built on a foundation of sand. And it's not just these two legendary investors. Something unprecedented is happening across the entire institutional investing landscape. In March 2025, hedge funds dumped stocks at a pace not seen in 4 years. Goldman Sachs prime brokerage data revealed that the two-day degrossing activity on Friday and Monday was the largest in 4 years. Hedge funds were retreating across every geographic region, except developed Asia, shedding positions in a coordinated fashion that sent ripples through global markets. By early March, global hedge funds had dramatically reduced their stock exposure over a 2-week period, generating the lowest rolling 2-week notional net flow measurement since records began. This wasn't a typical portfolio adjustment. This was an extraordinary level of liquidation that exceeded the selling during the 2018 correction, the 2020 COVID crash, and the 2022 bear market. Let's be clear about what we mean by smart money. These aren't retail investors scrolling through social media for stock tips. These are the professionals. Pension funds managing retirement savings for millions. Hedge funds run by teams with PhDs in mathematics and decades of market experience. Family offices representing generational wealth. These institutions have access to research that costs millions, proprietary data feeds, direct lines to company management, and trading algorithms that process information faster than any human could. They're called smart money not because they're always right, but because they have resources and information that everyday investors simply don't. When Goldman Sachs, JP Morgan, Bridgewater Associates, the world's largest hedge fund are all moving in the same direction, it's worth paying attention. And the direction they're moving right now is out. The pattern is unmistakable once you know what to look for. Before the dot-com crash in 2000, institutional ownership had been declining for months while retail investors piled in, chasing the internet dream. Before the 2008 financial crisis, the smart money had been reducing exposure to financial stocks and mortgage-backed securities while the general public remained oblivious. Before the COVID crash in February 2020, institutional selling accelerated weeks before the panic hit. The smart money doesn't announce their exits. They don't hold press conferences. They simply sell quietly and systematically while the market is still liquid enough to absorb their positions without triggering panic. By the time retail investors realize what's happening, the exits are already crowded. So what exactly are they selling? Let's look at the sectors where the selling has been most aggressive, because that tells us what institutional investors believe is most at risk. Consumer discretionary stocks have been the most heavily sold sector year-to-date in 2025. These are the companies that sell non-essential goods and services. Retail, travel, restaurants, luxury items, automotive, hotels, textiles. Everything that consumers buy when they're feeling confident about their financial future. When hedge funds dump these stocks, they're signaling a belief that consumer spending is about to weaken. And the selling has been relentless. Goldman Sachs prime brokerage data showed hedge funds were net sellers of consumer discretionary equities week after week, making it the most aggressively sold sector of the year. The selling was concentrated in North America and Europe, hitting retail and specialty retail stores, hotels, restaurants, leisure companies, auto manufacturers, and textile makers hardest. Why does this matter? Consumer spending represents roughly 70% of U.S. economic activity. If institutional investors believe consumers are about to pull back, they're effectively betting on an economic slowdown or recession. And they're backing that belief with billions of dollars in sell orders. The U.S. Conference Board's Consumer Confidence Index hit a 4-year low in March 2025. Tariff uncertainty has created chaos in global supply chains. Credit card debt is at record highs. Savings rates are declining. The signs that institutional investors are reading suggest that the American consumer, the engine that has driven economic growth for decades, is running out of gas. Then there's technology, the sector that has dominated market gains for the past several years. And here, the selling has reached an unprecedented pace. In March 2025, hedge funds sold off global tech stocks at the fastest rate in 6 months. U.S. tech stocks bore the brunt, making up about 75% of global net selling on Goldman's prime brokerage platform. Hedge fund exposure to the information technology sector fell to 16.4%, the lowest level in 5 years. This represents a dramatic shift in sentiment for a sector that had been the darling of institutional portfolios. The semiconductor sector has been hit particularly hard. After the DeepSeek disruption in late January 2025, confidence in the AI infrastructure thesis began to crack. DeepSeek, a relatively unknown Chinese artificial intelligence startup, dropped a bomb on Silicon Valley. The company released an AI model called R1 that claimed to match the capabilities of ChatGPT and other leading American AI systems. But here's what sent shockwaves through markets. DeepSeek said it spent just $5.6 million on computing power for its base model, compared to the hundreds of millions or billions that U.S. companies had poured into their AI technologies. And they achieved this using less advanced chips that were actually restricted by U.S. export controls designed to keep cutting-edge technology out of Chinese hands. On January 27, 2025, the market reacted with violence. NVIDIA, the leading supplier of AI chips and one of the most valuable companies in the world, lost $588.8 billion in market value in a single day. That's the most market value any stock has ever lost in one day, more than doubling the previous record of $240 billion set by Meta nearly 3 years earlier. The Nasdaq plunged 3.1%. The broader S&P 500 fell 1.5%. Approximately $1 trillion in market value evaporated across U.S. exchanges in a matter of hours. The DeepSeek announcement raised a question that sent ripples of concern through investors who had poured money into AI infrastructure companies. If a Chinese startup can build a competitive AI model for a fraction of the cost, using inferior chips, this could imply that the massive capital expenditures American tech giants are planning might be larger than necessary. Microsoft had announced $35 billion in investments to build AI and cloud data center infrastructure. Meta, Google, Amazon, all planning similar multi-billion-dollar build-outs. If DeepSeek is real, if their claims are accurate, then perhaps the market has dramatically overestimated the capital intensity required for AI development. And that would mean all those companies building data centers, manufacturing chips, supplying power infrastructure, they might be building for a market that doesn't materialize as expected. But the selling goes deeper than just consumer discretionary and technology. Credit markets, often called the smart money, S-money, because bond investors tend to be more sophisticated and risk-aware than equity investors, are flashing warnings that can't be ignored. Approximately $42 billion of U.S. corporate bonds were downgraded from investment grade to junk status in 2025, marking the highest total in a decade. When a bond gets downgraded to junk, it means credit rating agencies believe the company's ability to repay its debt has deteriorated significantly. These downgrades signal that corporate health is weakening across the board, that more companies are struggling with debt loads that were manageable when interest rates were near zero but are becoming problematic as rates remain elevated. Junk bond spreads, the extra yield investors demand to hold risky corporate debt instead of safe government bonds, have been behaving erratically. As of June 2025, spreads were at 2.96%, actually below the historical average, suggesting complacency. But by late 2025, distressed U.S. dollar loans had jumped to $71.8 billion, the highest level since April when President Trump outlined aggressive tariff policies. The CCC-rated bond market, the riskiest tier of junk bonds, dropped nearly 0.8% over the month ended in early November, underperforming the broader high-yield market as investors increasingly avoided the riskiest debt. What this tells us is that beneath the surface of seemingly calm markets, credit stress is building. Companies with shaky balance sheets are finding it harder to refinance debt. Investors are demanding more compensation for risk. And the gap between the healthiest companies and the weakest is widening. Historically, when credit spreads begin widening sharply, equity markets have followed with corrections or crashes within months. The credit market tends to see trouble before the stock market does because bond investors are primarily concerned with getting their money back, not making spectacular returns. They're the canary in the coal mine. And then there's the Buffett indicator, a metric that Warren Buffett himself once called probably the best single measure of where valuations stand at any given moment. The indicator compares the total market capitalization of all publicly traded stocks to the size of the economy measured by GDP. The logic is simple. If the stock market is growing much faster than the actual economy, eventually that gap has to close, either through economic growth catching up or through stock prices falling. As of June 30, 2025, the Buffett indicator stood at 217%. That's about 2.2 standard deviations above the historical average. To put that in perspective, the historical norm is around 125 to 130%. We're nearly 70% above the long-term trend line. The only times in history the indicator has been this elevated were during the dot-com bubble in 1999 and 2000, and briefly during the pandemic boom. Both times, significant market corrections followed. The dot-com crash wiped out trillions in value. Even Warren Buffett himself has walked back his endorsement of relying on any single indicator, but the message from this measure is unmistakable. By this metric, the market is pricing in perfection, assuming continued strong economic growth, expanding profit margins, and no major disruptions. That's a lot to assume. So we have the Oracle of Omaha sitting on a record cash pile. We have Michael Burry making his biggest bearish bet since the housing crisis. We have hedge funds selling at a pace not seen in years. We have consumer discretionary getting hammered. We have technology exposure at 5-year lows. We have credit markets showing strain. We have the Buffett indicator flashing bright red. The question isn't whether smart money is moving. The question is, what do they see that the rest of us don't? Part of what they see is written in black and white in 13F filings. Documents that institutional investors must file with the SEC every quarter disclosing their holdings. These filings come out 45 days after quarter end, so they're backward-looking, but they reveal the positioning of the smartest money on Wall Street. The 13F filings from the second quarter of 2025 painted a sobering picture. Warren Buffett's Berkshire Hathaway reduced exposure to Bank of America, Capital One, and Citigroup. He'd already slashed his Apple holdings by 67%, selling over 600 million shares worth an estimated $117.6 billion. Buffett once called Apple probably the best business I know in the world. For him to sell 2/3 of that position suggests he sees risk that outweighs the potential return. Third Point exited Tesla and Meta completely and trimmed Amazon. Duquesne family office dumped Alphabet, cut Tesla, and sold off airline stocks. These aren't minor adjustments. These are complete exits from positions in some of the most successful companies in the world. What's particularly notable is not just what they're selling, but what they're not buying. Family offices, which manage wealth for ultra-high net worth individuals and tend to have very long-term time horizons, are staying cautious. While they're not as bearish as short-term hedge funds, they're not aggressively deploying capital either. They're raising allocations to defensive positions, moving into sectors that perform better during economic slowdowns. Healthcare, consumer staples, utilities, the boring stuff. The stuff that doesn't go up as much in bull markets but doesn't crash as hard in bear markets. Now, this doesn't mean the crash is guaranteed or imminent. Markets can remain irrational longer than you can remain solvent, as the saying goes. And there are compelling arguments on the other side. The U.S. economy, while slowing, has not entered recession. Corporate earnings, while facing pressure, remain relatively strong for many large-cap companies. The Federal Reserve, while maintaining higher interest rates, has signaled it's done raising rates and could cut if conditions deteriorate. And artificial intelligence, despite the DeepSeek scare, remains a genuine technological revolution that could drive productivity gains and economic growth for years. But here's what history teaches us. When the smartest, most sophisticated investors with access to the best information all start moving in the same direction, they're rarely doing it for no reason. They may be early. Michael Burry was early on the housing crash, paying premiums on his credit default swaps for months before the collapse finally came. Warren Buffett built his cash pile starting in late 2022, and the market kept rising for another 2 years. Being early looks a lot like being wrong until suddenly you're right. And there are specific, identifiable risks that could trigger the correction that smart money seems to be positioning for. Tariff policy remains unpredictable, creating uncertainty for businesses trying to plan capital expenditures and supply chains. If tariffs escalate into a full-blown trade war, economic growth could stall. Geopolitical tensions continue simmering across multiple fronts, from Eastern Europe to the Middle East to Asia. Any one of these situations could flare up unexpectedly, sending risk assets plummeting. The commercial real estate market, particularly office space in major cities, remains under tremendous stress, with default rates rising and property values falling. This creates potential problems for regional banks that hold significant exposure to these loans. And consumer debt levels are at historic highs while savings rates have declined. If job growth slows or unemployment rises, even modestly, consumers may pull back spending sharply, triggering the recession that institutional investors seem to be preparing for. The artificial intelligence story, which has driven so much of the market's gains, faces a moment of reckoning. Not because AI isn't real or transformative, but because the market may have gotten ahead of reality. The infrastructure build-out, the massive data centers, the billions in chip purchases, all of this has been justified by expectations of explosive revenue growth from AI products and services, but monetization of AI has been slower than hoped. Companies are spending billions to develop capabilities that haven't yet translated into proportional revenue increases. If that revenue doesn't materialize on the expected timeline, or if competition like DeepSeek demonstrates that the technology can be developed far more cheaply than assumed, then the valuations of AI infrastructure companies could face dramatic resets. Perhaps most concerning is the simple mathematics of valuation. When the Buffett indicator is more than 2 standard deviations above its mean, when price-to-earnings ratios are elevated, when corporate profit margins are near peak levels, the asymmetry of risk and reward shifts. There's less room for things to go right and more room for things to go wrong. A market priced for perfection doesn't have much cushion to absorb disappointment. So what should investors do with this information? First, understand that selling everything and going to cash because Warren Buffett is holding cash would be a mistake. Buffett manages a company with hundreds of billions in equity value and wholly owned subsidiaries generating massive cash flows. His investment timeline and constraints are completely different from those of individual investors. He needs to deploy capital at scale into opportunities that meet his strict criteria, and in a richly valued market, those opportunities are rare. That doesn't mean individuals should follow his exact positioning. Second, recognize that hedge fund positioning is a tool, not a crystal ball. Hedge funds make wrong calls all the time. Many of them underperform simple index funds over the long term. Just because institutional investors are selling doesn't guarantee a crash is coming. It means they perceive risk has increased and are adjusting accordingly. But third, and most importantly, pay attention to the pattern emerging. When consumer confidence is falling, when credit markets are showing stress, when the most sophisticated investors are reducing risk across multiple asset classes and sectors, when valuation metrics are stretched, these aren't reasons to panic, but they are reasons to review your own portfolio positioning. Are you taking more risk than you realize? Are you overexposed to sectors that have already run up dramatically? Do you have a plan for what you'd do if markets fell 20 or 30% from current levels? The blackout, the moment when smart money disappears before a crash, isn't characterized by alarm bells and flashing red lights. It's characterized by exactly what we're seeing now. Quiet, methodical selling, record cash positions, defensive repositioning, falling exposure to the sectors that have led the bull market. Rising skepticism about the sustainability of current valuations. These are the warning signs, subtle but unmistakable if you know where to look. Warren Buffett famously said to be fearful when others are greedy and greedy when others are fearful. Right now, with markets near all-time highs, with retail investors still largely bullish, with confidence in American technological supremacy still largely intact despite DeepSeek, we're in a period of greed, not fear. And that's precisely when Buffett and investors like him become fearful and defensive. Michael Burry's massive bet against artificial intelligence stocks could be wrong. The Chinese AI challenge could fizzle out. Economic growth could re-accelerate. Corporate earnings could beat expectations. Institutional investors could be positioning for a crash that never comes. Markets could continue climbing for months or years, and those who sold could miss out on substantial gains. But here's what we know for certain. The pattern is real. The data is real. The cash pile is real. The selling is real. The credit stress is real. The valuation extremes are real. And historically, when all of these factors align, when smart money collectively reduces risk exposure while the broader market remains optimistic, the outcome has been the same far more often than not. Correction, sometimes severe. The blackout is happening right now. The smart money is making its move. The only question is whether you going to pay attention to what they doing or to what they saying. Because what they're saying is that markets look fine, volatility is manageable, opportunities exist. But what they're doing is selling, building cash, buying protection, and preparing for a storm that most people don't see coming yet. In the end, the market will decide. It always does. But when the historians look back at this period, when they analyze the data and the positioning and the warning signs, they'll see what was visible all along to those who were looking. The smart money saw it coming. They prepared. They moved early. And when the crowd finally realized what was happening, the exits were already crowded, and the blackout had already begun. If this gave you a new perspective on what's happening beneath the surface of today's markets, hit that like button and subscribe. Because when the pattern completes, when the correction that smart money is positioning for finally arrives, you'll want to understand not just what happened, but why you saw it coming all along. The warning signs are everywhere. The question is whether you're watching.